morning, Wealth Press traders, investors, subscribers. Welcome to another end of week market update. And I'm here as usual with Roger Scott. Roger, welcome.
Thank you for having me, James.
Roger, it's an interesting Friday morning. The VIX measure of volatility is ratcheting higher. The Dow started the day falling out of bed 200 points, while the NASDAQ 100 started up 100 and has just in the last 10 minutes dropped 100. Roger, what's driving the volatility in the market today?
Well, I'll tell you, it's actually very, very clear, and it's the unemployment numbers, James. The unemployment numbers that came. I'm surprised, to be quite honest with you, that the market recovered yesterday because the numbers came out yesterday. But I just don't see anything else. It's the fact that we're not having that Congress and Senate and the president are not jiving together to give us the stimulus, while Europe already announced yesterday that they were going to give stimulus there. We have jobless claims for the month near 850,000. To give you a perspective, before COVID-19, we were at 200,000. Now we're at over 800,000. But the bad part is this, and this is the part that I think it's finally hitting people. You know, when we have back in say March, April, May, we hit over 1 million, which made sense because we had a new vaccine. Then the numbers started moving lower, and we literally dipped our toe into the 600,000, I think, for one time. And the moving average started going down, the jobless claims. But it started moving down really quick at first, and then it just stopped. You realize we've been between 800,000 and 700,000 now for 5 months? So, and now it's going the other way up. So, it came off a little bit. It was still 3 times on average worse than the typical, and now it's going back up. And we're entering this late December, the whole thing we've talked about. This is the period of time when people get sick, when people get the flu, when people are most vulnerable. The majority of the world is not going to get vaccine tomorrow. The rate of this vaccine spiking back up, the number of unemployment claims, the consumer sentiment is going lower. It just doesn't make up for a good New Year's. We already started seeing retail sales numbers weaken as soon as November, with the expectations that they were going to get worse in December unless we got the stimulus. There's no stimulus. The Democrats and Republicans are completely out of whack with each other. And it's just not looking pretty. And I'm only talking about fundamental. And remember, I'm not even a fundamental expert. I'm a technical guy. You know, technically, forget about it. NASDAQ 100 diverging between the RSI. Put the call ratio all this week up to 2 days ago, up to the time we started, 0.65, which means greed is rampant. The type of stocks make.
Can you give me some clarity on that, Roger? Just
Sure.
Because 0.65, I don't understand the reference.
I'll definitely explain it to you. So we use this tool. It's an interesting tool because it's a tool that's random about 90% of the time. But when you get into that 10% window, it's super accuracy. The problem is it hardly ever gets there. So let me explain to you the basics of it. So you understand you have open interest on calls and you have open interest on puts. Okay.
Sure.
When the call open interest gets a certain percentage beyond the put volume, okay?
Yeah.
When there's more calls being opened than put by a certain ratio.
Sure. So it's just the numeric reference. 0.65 does not strike me as a big number. So what is that relative to?
It's an inverse calculation between the number of puts open to calls. So let me explain to you how it works. Anything below 0.70, okay, is telling us that the call buyers are just extreme buying, okay? Anything above 1.2 is telling us that puts are running wild. So if the market keeps doing what it's doing right now, you're going to see the put to call ratio spike above 1.10, 1.20. If it starts making new highs again and the market becomes really bullish, the put to call ratio is going to go down to 0.70. 70. It's a numeric calculation that calculates the differentiation between the calls and the puts.
Sure. So you're saying that the put to call ratio only matters when it's in the extreme regions of its range.
And that's actually what I'm about to get to. So
Ah,
if you look at the put to call ratio, 99, maybe as high as 95% of the time, it's useless because it's random, because the numbers are always between the 110 and the point 80. They just kind of randomly kind of drift through, and it's noise. You can't make heads or tails out of it, really.
so can I interrupt again? Does that mean that when the ratio is at 1, is that where put to calls are equal?
Yes.
Ah, okay. I got it now.
Yeah. Yeah.
Great.
It's
So
just,
0.65 indicates that there's 40% more sellers than buyers?
no, 0.65 says that there's that many more buyers than sellers.
Ah,
It works. Yeah. It's
I see.
the
The
opposite.
inverse correlation. I
Exactly.
got it.
Yes. You
Okay.
got it, except you're right. And then but here's the thing. If you look at the put to call ratio, it's random most of the time. It's useless. It's just it's like watching paint dry. But about once every couple of months, say, imagine a rubber band. And this rubber band is always kind of doing this. It's always kind of going back and forth, what a rubber band does. And if you don't stretch it out, it's going to keep doing that forever. But if you stretch out a rubber band really wide, it's going to snap back. And that's what the put to call ratio do. If you go to stockcharts.com and put in $CPC, you will get the put to call ratio. Okay? Stockcharts.com. And I'm telling this for everybody at home as well. Just go, it doesn't cost anything. Just go to stockcharts.com, put $CPC. Okay? And you're going to get the put to call ratio, and you'll be able to see it graphically. And I like to use a line chart because it's not really a bar, it's more of a line. And you could see when it goes extreme up or down. And not all this week, Monday, Tuesday, Wednesday, it went below 70. It went to about 65. And I was warning everyone. I was doing my morning videos, and I was warning everybody. And I said that rubber band is stretched out. And when that rubber band is stretched out, we all know exactly what it's going to do. If you look at any major market turning point, James, you will see that put to call ratio is stretched out to the tilt. And I'm not the only guy but here's the problem. A lot of traders like to make heads or tails out of it when it's not really significant. So
Right.
you've only got it. It's random unless it's extreme. That's how I look at it. So it's one of those things you never want to look at. And then you want to look at it when it's just like, stretched out.
Right.
And it's stretched out. And it's really, and that's what, and if you looked at my morning videos on Monday, Tuesday, Wednesday, I was saying the put to call ratio is stretched out. Moreover, if you look at the NASDAQ 100 or the S&P 500, and if you put a 10-day RSI oscillator, just a standard 10-day oscillator, you will see that the highs on the oscillator are getting lower over the past 3 months. So the highs are going lower on the oscillator while price continues going higher. That is even more important than the oscillator itself, because that's telling you that there's divergence between price and momentum. And that's even, a lot of traders, they like to use the RSI, and they like to use it for overbought, oversold, which is fair. I mean, it works sometimes, but it works really, really well for divergence. And just so you know, the trading action it's showing right now, or was showing up till right now, was exactly the same type that we saw in the late February preceding the correction. If you look at the S&P 500 and if you look at the RSI, you will see one, and I'm not talking about 2-3 days. I'm talking about 2 months. The RSI keeps making lower highs, and the NASDAQ and the S&P keep making higher highs.
Right.
That's classic divergence. And typically, that's like that rubber band. That's a rubber band that's just waiting to snap back. And the longer the divergence, the better the pop. And that divergence has been happening ever since, I would like to say, September, James. Now here's the kicker. Where we are. If you look at the Russell 2000, and if you look at emerging markets, either ticker symbol EEM or VWO, you will notice that they're also making highs, really strong highs, better even than the S&P and the Nasdaq 100, but the oscillators are not diverging.
I see.
So this
Okay,
is,
so I'm looking at the total put to call ratio right now, and it's at 0.51.
yes,
So that strikes me as extreme.
extreme, extreme.
So that suggests there's twice as many uh, enthusiast buyers than there are sellers of the market generally.
Yes, yes.
Wow.
And
Okay.
and and what we like to call the put to call ratio, it's like the smart money versus dumb money indicator. It's almost because when you see markets going higher and higher and higher, retail traders just keep pumping their money into it and into it. They get that greed factor gets really crazy. And what happens when a lot of beginners think that something's going to happen? The market flips. So the put to call ratio is a smart, we call it smart money versus dumb money indicator, for lack of a better term.
Okay, so this put to call ratio, it's been fluctuating like crazy for the last few months.
Yes, it has. And remember what I say, usually most of the time, the majority of the time, it's random. It
Right.
doesn't, you've got to look at extremes. And the extremes that I like to look at is anything below 0.70 to the call side and anything above 115, 120 to the put side. And those are extremes.
Interesting. Okay,
Yeah.
so I look at this and I see that, the put to call ratio changes in a heartbeat. If the Dow drops, say, above 6% in a given time frame in a single day, then that put to call ratio flips almost right on the heels of it, does it not?
Yes, it does. Yes, it does.
Oh, okay.
And
So
that's why,
these are
go
more or
ahead.
less confirmation of what is happening rather than useful predictive tools on a technical basis. Is that accurate?
That is 100% correct.
Okay, because I'm looking at, the VIX is now up at 23. It's been bouncing along around 20 for the last couple of weeks, but now, of course, just like the put to call ratio, the VIX is also something that is great for confirming what the sentiment is at this moment. But in terms of using what's happening now to predict what's happening in the future, that's a very difficult proposition. It's not really useful for that. So because I'm looking at this whole correction right now and I'm thinking, okay, well, the headlines are obviously driving negative sentiment into people buying stock rather than people in the options market. The options market tends to be occupied by a level of sophistication and financial literacy a little bit higher than your traditional retail investor. Would you agree with that?
Yes, absolutely.
So
Absolutely.
is it not then because we've been living in this crazy reality where the market doesn't care what's happening in the real world. It doesn't care that infections are spiraling out of control. It doesn't matter that employment numbers are skyrocketing. It doesn't matter that there's no compromise in Congress. It just keeps on keeping on, largely due to the liquidity load implied by continuous central bank stimulus. So should we be looking at this? Like, for example, I just want to put this out there because I did something that I'm not used to doing, which is I waded in and I bought some SPACs just earlier in the week. And given what's happening in the markets generally, the SPACs are not performing that well. And so,
Right.
The unsophisticated, financially less literate response would be to panic and sell, especially on a day like this where you're seeing big moves in the broader indices. I'm not going to fall into that trap and lock in my loss. I'm going to wait for this convergence of bad headlines with Christmas and COVID to do what it always does, which is pass us by, and wait for the market to resume it's unstoppable bull
Exuberance.
phase due to all of this stimulus money. And we know that even though that there's a roadblock or a sort of there's a lack of disagreement right now, we know that when Joe Biden takes office in 2020, there's going to be more stimulus somehow. I think Congress and the House are going to be more interested in making sure that they get some stuff done because neither one of them wants to wear the blame of causing people to lose their homes, their jobs, lose their heating in a pandemic.
Right.
So is that really what our audience should be sort of doing, is saying, well, yes, I'm a little bit underwater today, especially in my shorter term swing trades, but I'm not going to panic and hit the sell button, even though if I was a day trader, I would sell because I know I can buy it back as soon as I perceive the reversal from this correction. But I'm not a day trader. I look at the markets in the morning, again in the afternoon. In the meantime, I've got bigger fish to fry. I'm running a farm. I've got writing to
Sure.
do. I've got video to produce. So it doesn't really bother me. And is that
Well,
what I should be thinking?
it's a loaded question, and I'll tell you why. Because we have readers, and I'm not day trading. You're right about the day trading part, but we have a lot of people who are watching this, who are reading our reviews, who are our videos and so forth, who are swing traders, and they're right now timing the market. They may not be day traders, but they're in the market for a 2, 3, 4 day swing. And I'm going to tell you, it's when you're doing that, these put the call ratios and these divergent levels can come in very, very timely. Like, for example, beginning of this week, I was telling people, based on these things, these factors that I was seeing and these confirmations, that they may want to get out of tech and start getting into cash and ETFs. And if this continues going lower, to go all cash. So it's a way for people to rotate, take profit near swing highs, and wait for that market to come down and buy again. Or conversely, make money to the short side. Like, for example, we're looking right now to buy some VIX options because we think this may continue for a few days. If those VIX options continue moving higher, we could make potentially, obviously, this is not we're not Nostradamus here, but we have potential to make 100, 200, 300% return on those options in a very, very short time. Or conversely, save and create a better cost basis for our clients because they're swing trading. So again, if you can time these and predict them in advance, just a few days ahead of time, it gives people time to reposition, readjust, move from large caps to small caps, or from stocks to cash, or so forth.
Sure. Sure. All that timing and everything must be, I mean, I wonder what kind of win ratio you would have when you're constantly trying to time swings versus taking a position from a value fundamental perspective in a company that you say, oh, okay, this company just merged with the SPAC. The SPAC had 900 million in cash. The company had 600 million in sales and is now trading at, a low multiple towards earnings. I'm going to buy it because I think the value in the market will be recognized and it will go higher regardless of the volatility on the day-to-day and the option side. Is that sort of the trade-off between being a sort of short-term or even longer-term investor versus being a swing or day trader? Is that you're doing a lot more trades in those shorter windows, and you're sort of trying to read a lot of tea leaves and time your placements, your entries and exits according to where those tea leaves fall. Whereas with an investment, it's really a simple proposition. The company's worth what it's trading at, or it's worth a lot more. And so
And
I find, and this is why I walked away from day trading and swing trading decades ago, is because I prefer the much more bucolic existence of a glance at the markets in the morning and a glance at them at night and a look at the global fundamentals, and knowing that in my heart, yes, gold is going to increase in price over the longer term because there's too many American dollars out there. Yes, desktop metal is going to achieve a higher market cap because it just merged with a $900 million capital pool and has escalating profit projections. So is that the trade-off?
the trade-off is that it's not one thing you mentioned, the profitability. It's the risk and the downside. It's the risk-adjusted returns. While you may be right and you may not have to sit in that asset, I mean, you may sit in that asset for a while, but you may incur a higher level of risk and volatility compared to the swing trader. So where the swing trader does more trades, and remember, I'm not a big day trader at all. I'm not a day trader at all, to be honest with you. I'm not. I've never been one. But there's just not enough trading action during the day to make enough money versus the risk, in my opinion. but some people may like it. But I love swing trading because you get to benefit from those upside swings without sitting in that drawdown or keeping your money tied up for a long time without activity. So it's not about profitability. It's profitability in light of the risk and the volatility and the time. That's how you have to look at it. And that changes everything completely.
Sure, sure. As an investor, your value is at risk all the time until you
Right.
exit the investment. The swing trade, your value is at risk for precisely the period of the swing. And I could see where that is. There's a trade-off for that mindset. Is that's a very calming effect if you
Let me
have low tolerance for volatility. Is that you're out of the market at the end of every strategy.
let me give you let me put some numbers on that, okay? So
Sure.
let's say we go about your way. We just kind of let think your over a 10 and again, I'm just using the past to show what would have happened, not going forward. This is just kind of like a fingerprint of the past, your way versus the opposite way. So and this is a very good example, actually. So I took the S&P 500. No, was it the Dow? It doesn't really matter. I took the stock market, the S&P 500, and we put it over a buy and hold parameter. The average annual return buy and hold was about 6%. The drawdown, the swings were 24%. So 6% upside, downside swings. It wouldn't matter because you're still holding, but you have to experience that. Your stomach, your mind, and for many months, you're underwater up to 24%, but your upside potential is 6%. Exact same system, okay? We use a 200-day moving average. We literally, over that 20-year period or whatever the test is, we make three trades or 5 trades, okay? We're not buying and holding. Now your profit, now your risk drawdown is at about 4%, and your profitability averages 12%. Like literally a handful of trades, literally putting a 200-day moving average line.
Right.
So look at how that shakes out. I can now achieve the same result that you can with 3 times less risk. Or I could use exactly the same amount of money you have, but I will potentially make 3 times as much and have the same risk profile.
Right. I get it.
By simply using a 200-day moving average and making 5 moves in 20 years.
Wow.
So don't quote me on this. I'm trying to remember the back test, but it was something like that. It was something where the profit was 6%, the downside was like 24% on the buy and hold, but on using a simple 200-day moving average, you only made like a handful of trades, but your upside and your downside and your hold, everything completely changed, like so much better in your direction.
Right.
So there's many and James, we're not talking about swing trading when you're even watching the market every week. You could have done this is like making a move every 6 months.
Right.
So and I'm going to do 10 strategies like that. I'm going to actually that's one, and I'm going to email it to you. I'm going to look for it and I'll email it to so you have it. But I'm going to do a little repertoire on this and show people the buy and hold versus making very simple moves where you're literally like not even watching the market, where you literally have to do something once every 6 months. That's also swing trading, right? That's timing the market. But now your entire fingerprint is different. And now your profit is different, your loss is different, your holding time, and it's a lot more favorable. So there's different levels of swing trading. You see what I mean?
Yeah, absolutely. Okay, so where are you swing trading today?
Good answer. Well, here's my point of view. I'm running away from large cap technology. I think the market, the Nasdaq returned 28 or 35%. And again, don't quote me, but somewhere between 30 and 40% for the year, up to the upside. That's way too much too fast. I think the large caps are overdone. I don't think the political climate is going to be favoring large tech because Democrats like to break apart big companies. I think the good stuff is going to be in the non-tech and in the mid caps and the small caps. Matter of fact, I kind of knew you were going to ask me this question, so I decided to give you some stocks that I'm expecting the biggest gains for 2021, and these stocks are all stocks that have gained over 20% in the last 30 days. All right?
So these are picks for the future, though.
Yes, but they're already on the tear, and they're
Okay.
non-tech. So you can kind of see what I'm looking at. United Rental, ticker symbol URI. We called it about 2 months ago. It has gone up about 45% since we called it. Another stock, Albemarle. It's a leading lithium stock. We recommended it about 2 weeks ago. It's up about 15% since we recommended it.
Yeah,
And in
I know
the
Albemarle well. I know Keith
yeah,
Luke Kissam, who's the CEO, has been on my show.
great company, highly recommended for 2021. The stock is up 25% in the last 30 days, and I'm expecting good returns through the first half of 2021.
Wow.
Some other stocks, I like Disney. I think Disney's going to start seeing upside. It's up 20% in the last 30 days. I like L Brands, which has been my top 10 stock in the last 6 months.
L Brands, is that the one with Kathy Ireland?
Not sure.
No,
I'm not sure.
that's
But it's
Level Brands.
ticker symbol L, and they've gone up over 20%, and they've been my top stock for the last 6 months.
Hmm.
And I'm expecting more upside. And TJX, I don't know the name of the company, but its ticker symbol is TJX, up 21% in the last 30 days, and I'm expecting good growth over the next quarter to two. I can't predict throughout the entire year, but I think the first quarter to two, these companies will do well. And notice none of these are tech stocks.
Sure. So are these swing trades that you're putting on then that are
Yeah.
good to capture the reversal in the market that'll happen in the new year?
Yes, what I'm looking for is I'm looking for the market to hit. I'm looking for the S&P and the Nasdaq to hit the 50-day moving average, and when it starts moving back up from the 50-day moving average, that's when I would potentially be buying these stocks.
Fantastic. All right, Roger, let's leave it there for now. It's a great update as usual. Thank you very much for joining me. Have a fantastic weekend. We'll see you next week.
Great session, James. Have a great weekend. Bye.